This is level 2 of the CFA program, the topic on derivatives and the reading on valuation of contingent claims. And this is part 2, the Black-Scholes-Merton option pricing model. Let me just remind you that part 1 was the binomial option pricing model, in which we showed you that the price of a call and a put option is really nothing more than a present value. And so that binomial model was consistent with asset pricing that we've learned throughout the CFA program. And the Black-Scholes-Merton option pricing model is going to be no different. One of the interesting things about these LOSs here for Black-Scholes-Merton is that there is no calculate or compute, but there is a whole bunch of describes and interprets. So what we're going to do is we're going to take you through some of the calculations so that you can describe and interpret. Most of these LOSs are pretty similar to what we had back in the binomial option pricing model LOSs, with the exception of the compute action word. But hopefully when this slide deck is completed, you will say to yourself, you know what, Jim, this wasn't nearly as bad as I thought it was going to be. Now, what I want to do is give you an example that is not in the reading, but it goes a long, long way in helping all of us better understand what Fisher Black and Myron Scholes and Robert Merton were trying to do with the Black-Scholes-Merton option pricing model. So I'm going to go ahead and start with just a simple call option. Now, at the risk of offending you and reminding you, let's go ahead and simply state that a call option gives the owner the right but not the obligation to buy an underlying asset, in this case a share of stock, at a fixed price during some specified time period. So notice that first arrow point. Consider a 6-month call option. And so let's pretend that we're two different parties. I'm the writer, I'm the seller of the option, and you are the buyer of the option. So I'm selling you the right but not the obligation over the next 6 months to buy a share of stock for $90. There's that strike price or exercise price. Interest rates are currently 10%, and so the value of this option depends on a couple of variables, but it also depends on what the price of that share of stock is. So the current price is $100. So let's think about that. You have the right but not the obligation to buy a share of stock for $90 from me, when if you were to go to the floor of the New York Stock Exchange, you'd have to pay $100. So this option clearly has value. We call that difference, 100 minus 90, that $10 difference, we call that the intrinsic value of the option. So clearly today, I'm going to charge you more than that intrinsic value of the option, because I would have to have my head examined if I were to sell that option to you for $1 or $5 or $9, because you would make an arbitrage profit and you would do this over and over and over again until I was broke. So the question then becomes, how can we value this option? And the simplest way to do this is to go ahead and skip ahead 6 months to the expiration date. So that's what we have on that second arrow point. At expiration, let's suppose that the stock price is exactly that $100 current stock price today. This option will be in the money, right? You have the right to buy from me at 90, and the stock is trading at 100. And so what you will do is you will exercise your option. So you'll come knocking on my door. You'll say, hey, Jim, remember me? I bought this option from you. Sell me that share of stock for $90. Now, we could go through the whole process of me selling you the share of stock, and then you may not even want to own that stock. So you may have to go sell it somewhere else to get your $10. But the easiest thing is for me just to reach into my pocket and hand you $10. That's why the overwhelming majority, 98 or 99% of all derivative contracts are cash settled. They don't have to be, and some aren't, but most of them are cash settled. So the value of the call at expiration is just the $10, 100 minus 90. But the way more interesting question is, how much am I going to charge you for that option today? And that's that third arrow point. Before expiration, we have 6 months to go. So let's go ahead and scratch our heads for a second and remind ourselves what we talked about with the binomial model. We learned that price of an option is the present value of those expected payoffs. Go ahead and visualize, the 1 period model where we went out like this, and then the 2 period model where we had a bunch of those tree branches going out. And all we did was we took those expected payoffs and we discounted them back to the present. So you should be thinking to yourself, okay, Jim, there has to be a present value somewhere in there. So I want you to look underneath that second arrow point. Value of the call is equal to the stock price at expiration minus the exercise or the strike price. And we got that $10. So the question is, how can we get that answer before expiration to be greater than $10? It has to be greater than $10. Well, that stock price at expiration, or that stock price today, that's a present value, right? We did that with the Gordon growth model back in level 1. So what we do is we take the present value of the strike price or the present value of the exercise price. So go ahead and look under the third arrow point. The value of the call today, 6 months before expiration, is going to be the stock price today. There's that sub-zero minus the present value of the strike price. And notice that we assume continuous compounding in the option pricing world. And so we take that little e raised to the minus r, which is interest rate, times time, which is t, right? So all we're going to do is take the 100 stock price today minus the present value of that strike price, assuming continuous compounding, and we get $14.39, which of course exceeds that $10. So notice what the value of a call is according to the simple option pricing model. It's the difference between the stock price and the present value of the strike price. So there's that present value concept that we're familiar with since the very beginning of level 1 and hopefully the very beginning of your college days. And we get $14.39. So let's make sure you understand what's happening. Today, I'm going to charge you $14.39. I'm going to hand you a piece of paper that says, hey, this gives you the right but not the obligation to buy at 90, and you're going to hand over $14.39. Now that has two components. It has an intrinsic value component, which I mentioned earlier, which is just going to be 100 minus 90. There's the $10 worth of intrinsic value. And then the difference is known as the time value of the option. And so this goes a long way in setting the table for the Black-Scholes-Merton option pricing model. Now, note the last arrow point down there, function of 4 variables. So the simple model tells us that call prices are a function of stock price, there's 100 in red, exercise or strike price, there's the 90 in blue, interest rate, there's the 10% in decimal form. Don't forget to put that in decimal form. That's in, what color is that? Orange. And then the 0.5, which is a half a year, that's in purple. Now, before I get to the Black-Scholes-Merton option pricing model, I want to go ahead and ask you the following question. Note that if this scenario up in that first arrow point was a call option written on the shares of, let's pick a stock, let's say Amazon. Strike price of 90, current price of 100, we'd come up with $14.39. But let's take a different kind of a company. Suppose this scenario was written for Aqua America Water Company, and we had those same variables, stock price, exercise price, interest rate, and time. We'd come up with that same $14.39. So clearly, at the bottom, the value of the call is a function of 4 variables in this simple option pricing model, but we're missing a 5th variable. What's the difference between Amazon and Aqua America? Well, clearly, the standard deviation of those 2 underlying stocks is extremely different. So we need a 5th variable, and this is what Black-Scholes-Merton did in somewhere around 1970. They added a 5th variable that measures volatility to the simple option pricing model. So identify assumptions. Here's this good LOS. So look down, what's that? The fourth one down in purple. The volatility of the return of the underlying is known and it's constant. So there's our measure of standard deviation that we've talked about for a long, long time as a really good measure of total risk. So the first thing that you need to know about the BSM model is that it adds a fifth variable to that simple option pricing model. And that fifth variable is the volatility of the underlying asset. And then the next part of that assumption is that we know what that volatility is and that it stays constant over that life of the option, which may or may not be highly restrictive assumptions. Let's take a couple of these easy ones first. So just work our way down. Unlimited short selling is permitted. That makes perfect sense here. No taxes or transaction costs are imposed on either the buyer or the seller, you or me, in that original transaction. And then we trade continuously in a very small number of units. Let's go ahead and work our way back up. Risk-free rate of interest is constant. And recall what we talked about back in the binomial option pricing model where we did some hedging and we decided that, the risk-free rate of interest is relevant to price a risky call option for a variety of reasons. But here's another really, really cool assumption is that the risk-free rate is available for both borrowers and lenders. No risk-free arbitrage opportunities are available. And then let's go ahead and look at that first one and talk about this for just a second. Price of the underlying share follows a geometric Brownian motion. Now, what this means is that the logarithm of the underlying stock price follows this Brownian motion. And this Brownian motion, just quite simply from a calculus standpoint, tells us that the stock price or the underlying asset price is a function of a handful of variables. Now, stock price, a handful of variables, one of which is the expected return on that underlying stock, and the other of which is the volatility of that return. And so if you have any knowledge of calculus, or go ahead and look at the actual reading, there are some really cool equations and just a handful of introductory derivations. But what I would suggest in terms of knowing what that assumption means is that remember logarithmic, and remember the underlying stock is a function of expected returns and volatility. You won't have to know any of the calculus that is underlying it, which means, and go ahead and read in this reading about Ito's lemma. That's a lot of fun. All right, this is a big LOS here. Interpret the components. So what I've done so far is taken 10 minutes or so of your time so that I didn't just throw this European call and European put option pricing model at you. So I want you to pretend that the red stuff isn't there. Notice that we have the call price is equal to the stock price today minus the present value of the exercise price. Forget about the ND1 and the ND2. That is our simple option pricing model. And so the ND1 and the ND2, these are the additions of this fifth variable that includes volatility. So really what Black-Scholes-Merton simply did, and of course, two of them won the Nobel Prize in economics, and Fisher Black, of course, would have been a part of that had he been still alive, but they earned this prize because they added volatility to the simple option pricing model. Now, the fascinating thing is that the legend goes that a handful of academicians were sitting around talking about the molecules and the heat transfer equation. And I believe it was Fisher Black scratched his head and said, when the molecules are transferring heat in boiling water, that sounds an awful lot like what stock prices do on the floor of the New York Stock Exchange. So that was kind of the impetus that led to the development of this model. Now, another fascinating thing is that ND1 and ND2 are probabilities. So they're going to be between 0 and 1. So let me give you this interpret the components. Are you ready for this? The Black-Scholes-Merton model is nothing more than a probability-weighted simple option pricing model. We're going to weight the stock price, and we're going to weight the present value of the exercise price by probabilities. And this goes all the way back to what we learned in quantitative methods and quantitative analysis in level 2 and back in level 1. And of course, we'll learn more about it in level 3. Now go ahead and skip down to the bottom part there where the D1 and the D2, these are the challenges for any candidate and any undergraduate and graduate student to calculate the price of a call or a put option. But of course, there is no action word of calculate, but we're going to have to interpret it. And this is going to be super, super important. So let's go ahead and work through an example here. So let's go back to my original stock price of 100, exercise price of 90, 6 months, 10%. And then let's add a fifth variable of volatility, 25%. So what we need to do is we need to calculate D1 and D2. And then, here, let me go back here. And then we need to look those numbers up on the table. And if you look at this table that we have for you on the right-hand side of this slide, you won't see a D1 or a D2, but you'll see a Z. And you're thinking to yourself, wait a minute, I know that Z table from somewhere else. Of course, this is our Z table. So before we do the math here, I want to call your attention down to the bottom right of this slide. Notice that that equation for the Z-score or the Z value is the difference between X and mu divided by the standard deviation. And so let me go ahead and just give you just a quick example here. And I think this is going to go a long way in helping you to answer questions about interpret. Trust me on this, all right? Let's suppose that we're football fans, like I am, and we want to know something about probabilities and likelihoods of an outcome for an NFL game this Sunday. In particular, let's suppose we're Kansas City Chiefs fans and Patrick Mahomes fans, and we think Patrick Mahomes is gonna do really well this Sunday. So we might say something like, hey, I think Patrick Mahomes is going to throw 5 touchdown passes. And we might have a friend who doesn't like the Chiefs or doesn't like Mahomes for whatever reason, and they say, no, he's not any good. He's going to throw 10 interceptions, not 5 touchdown passes. And so basic statistics is rooted in this concept of having an argument. I think one thing, you think another. But smart men and women over the years have said, wait a minute, we can disagree, but we can use mathematics and statistics to see who is right. So in order to do this, we'll say something like, all right, let's go ahead and let's collect all of the touchdown passes from all of the quarterbacks that have ever played in the NFL. That would be the population, right? So we're going to compare Patrick Mahomes to the population. And then we're going to say, well, we think he's better than the population, better than average, let's say, or worse than average. And so notice in the numerator, there's always an X minus a mu. There's always an expectations in the sample. That would be Patrick Mahomes' performance. And what is truly the observable number of touchdown passes that are out there. That might be considered the population. So in statistics and in Z-scores, we're always looking for the difference between the two. That's why we have a minus sign in the numerator. And then, of course, we divide by the standard deviation. We always divide by standard deviation to standardize some kind of a score so that it follows some kind of a distribution, maybe a normal distribution that we can wrap our hands around. All right, so keep that in mind here. There's a minus sign in that numerator. Well, what Black-Scholes and Merton found was that call prices and stock prices, they follow this kind of a normal distribution, and the Z-score can be used. And those Z tables can be used. And since Z was a letter that was already taken, they just picked D. I've never read anything about why they picked D. Maybe one of you guys knows that, and you can let me know. So let's go ahead and compute the D1. And so you can readily pause the video and make certain that our mathematics is correct. But I want to call your attention to the third equal sign down there. So we do all the math and we get an equal sign. And we get that 10.53%. So skip above to the line right above of it. We take the natural log of 100 divided by 90. That's 10.53%. What is that? If you buy that share of stock from me for 90 today and you immediately go sell it today for $100, you get 10.53%. That's the continuously compounded return on intrinsic value. Now, let's do a plus sign here, and I'll come back to that in just a second. Do all that stuff over there. So what do we start with? We started with that risk-free rate, and then we added the variance, right? 25% is the standard deviation squared. So that's the variance divided by 2. And by the way, the divided by 2 is just the result of solving in that Brownian motion process for a stock price. So don't worry about the divided by 2. That's the result of some calculus. And then it's weighted by time. So if you do all that math, you get 6.56%. Oh my gosh, what is this? This is the continuously compounded return on time value. So what did we say in a slide or two ago? You were going to pay me $14.40 or somewhere around there, right? 10 of it was intrinsic value, and $4.30 some cents was time value. That's why Black-Scholes-Merton won a Nobel Prize in economics, because they realized that we don't want to minus over there like we do in regular old statistics because two people are arguing about Patrick Mahomes and how many touchdown passes. We know that the value of a call option is a combination of intrinsic value and time value, so we add those two. So look at the interpret part of the LOS. You can interpret that as return on intrinsic value and return on time value. That's a tremendous question on the exam. And then we divide by the standard deviation, but we know that standard deviation moves through time at the square root, so we have to adjust it down there. So we get a D1 of 0.9672. And then the calculation of D2, that's super easy. That's just D1 minus the denominator of D1, and that gets you 0.7904. So now we are ready to get out our, are you ready for this? Get out our D table, but we don't have a D table. We have a Z table. And so all we do is run our fingers down, run our fingers across. Notice that we have put them in red and blue. So pretend that the red and blue isn't there. What does that look like? That's the simple option pricing model. But now we weight them by probabilities, 83% and 78%, and we get $16.17. This is a probability weighted simple option pricing model that adds, ready, that adds the fifth variable. And how does it add that fifth variable? It uses logarithms, it uses a Brownian motion process, and it uses Ito's lemma and a Wiener process as well. All that other stuff that you guys don't need to know. So what did we get before? I'll go back to this other slide. What did I give you there? $14.39 was our simple option pricing model call price. Now we've got $16.17. And this one is way more accurate. Let me tell you a quick story here. Maybe this will help you. Years and years ago, I took my students to the Philadelphia Stock Exchange back when it existed. And in a small room in the back, they had the Philadelphia Options Exchange. And so we went back there, and it was so exciting watching these traders. And I was watching this one guy who was using this little, this is probably 20 years ago, this little old computer screen. It was green, and I was like, I went up to the guy, said, was like, dude, what are you doing? He goes, this is my proprietary Black-Scholes-Merton option pricing model, and I'm using it here, and I'm looking up there at prices, and I'm trying to decide, okay, am I going to long or short? What am I going to do, buy or sell? So there's no doubt that this BSM model is a super cool model from a mathematical, from a calculus standpoint, but also, let me go back here, from an interpretive standpoint. But it is used all the time by traders and investors and arbitrageurs and all sorts of people. So now you have the basis of understanding this, interpret the components. And from my view, that whole exercise that we went through with the simple option pricing model was super helpful. All right, so this is just a summary page here, right? So there's the following variables, the 4 of the simple model plus volatility. But let's go ahead and interpret that ND2. This is really the important one. This is the probability that a call or a put option will be exercised at expiration. That's an important interpretation there. I would like take a picture of that and just memorize that statement, because that sounds to me like a really, really great exam question. Option value, expected payoffs. We did that with the binomial model. We're doing it again today. But look at those last two. I like these last two. A call option can be viewed as a leveraged position. So, of course, with leverage, we've got to borrow. What are we borrowing? Well, we're going to borrow the present value of the exercise price and then use that capital to buy some units of the shares of the underlying asset. Put option, on the other hand, is kind of a little bit the reverse. We're going to buy a bond, and that's a risk-free bond, by the way, and we're going to finance that by short selling the underlying stock. So remember, call option, you buy the shares of stock. Put option, you short the shares of stock, and you combine them with something else. Let me go ahead and just give you a quick summary here. Note that you don't have to calculate that price, but it's my advice to go ahead and just pick 5 numbers and go ahead and calculate them. There are really cool web pages out there that you can just verify your answer. So just type in a search for call option price calculator, do the math, and then interpret it, just like I did back here. Interpret intrinsic value and time value, and we're dividing by standard deviation weighted by the square root of time. If you do that one more time before the exam, I think you'll be able to interpret the components of the model. So what we're going to do now is move on to how this model can be applied to other underlying securities. So read this one here. Describe how the model is used to value European options on equities and currencies. All right, so what we need to do is we need to add a dividend to what we've done before. And this is a super simple addition. So notice that first diamond point. Assume that we have a continuously compounded dividend yield. And so look at the formula for the adjusted model European call option. So it looks identical to what we've done before, but notice after the stock price, current stock price, S sub 0, we have E to the minus dividend yield times time. So all we're doing here in the red bolded part of the call and the put is that we are simply taking the present value of the stock price. We're discounting it back by the dividend yield, which sounds a little bit strange. But the reason we do that is simply because if you own the call option, you don't receive the dividend. If you own the underlying shares, then you do receive the dividend. So back in our example, what was that stock price? 100. So if the dividend yield, I mean, what are dividend yields these days? You know, maybe 1% or 0.5% or 2%, whatever that number is. If you put that in there, you know, you might get, instead of $100 into the model, you know, maybe you'll get $99 and, 45 cents or 55 cents, or maybe even 99 cents, right? And so the dividend yield adjustment is really a super slight adjustment. But then go down to the very bottom there. Notice that in red bold, I've taken the dividend yield out of that risk-free rate of interest. So just remember those two adjustments. For currencies, it's virtually identical, but we need to make certain that we're aware of when we're valuing a currency, like the US dollar per Canadian dollar, we need some kind of a measure of an interest rate, but we're going to have an interest rate in the United States and an interest rate in Canada. So we need to kind of figure this out. How do we deal with two different interest rates? Well, notice what we've done for you again here in red. We've done the same thing. Notice that in black, everything stays the same. And so look at the European call all the way at the end. That's still E to the minus RT. So that is still the domestic risk-free rate of interest. But now we're going to take the present value, so to speak, of the stock price, and we're going to use that foreign risk-free rate adjustment. So look here, back here. Here we're discounting at the dividend yield stock price. Here we're discounting at the foreign risk-free rate of interest stock price. And so I think that gets you answers to describe how you can handle dividend yields and currencies. Now, how about if we move this to options on futures contracts? I think these are super cool. I always tell my students that these are like a double derivative, right? You have a futures contract, which gives you the obligation to trade some underlying asset. You take short and long positions. So now you have the right, but not the obligation to trade at some time in the future, double derivative. And so the equations are virtually identical, but instead of stock price in there, we have the underlying futures price. There's the F0 sub T. And then again, since we're doing this for both, since that's a futures price, we're taking the present value. So we just, what do you call that in algebra? You factor out the e to the minus RT, and then those equations are virtually identical. How about interest rate options and swaptions? Oh boy, this is super cool. I did read in the actual reading that there was a paragraph there in the conventions of the actual over 365 versus the 30 over the 360 and those two conventions. So just remember that interest rate options use the actual number of days divided by 365. And of course, the underlying asset in an interest rate option is a forward rate agreement. And so those formulas and those equations are virtually identical. So what I want you to do is skip over to the part inside of the brackets there. So there's and forget about the ND1 and the ND2. There's our forward rate agreement. So there's an interest rate, and then the R sub K, there's another interest rate. There's the exercise rate. So we don't call it the exercise price, we call it the exercise rate. So just like in my example earlier, what did we have? We had $100 minus $90. Well, instead of dollars, we're going to have an interest rate. So it might be 10% minus an exercise rate of 5% or 6% or 7%. And once again, we're going to weight them by our ND1 and our ND2. Those are still probabilities. We're still going to calculate them in a similar manner. And you can look down below. There's the D1 and the D2. So you do all that stuff. I mean, it's super similar. But then outside of the brackets, in front of the brackets, we need to take that accrued period and take the present value of that. So we're just taking present values based on what that accrued period is. There's that AP. And this is probably a summary point slide from what I was just saying. Yeah, fixed rate on a forward rate agreement, a time period that expires sometime in the future, right? RK is the exercise rate. We said that, underlying volatility. So there's the accrual period, the AP. Couple of things. The underlying is an interest rate, not a price, right? The discount factor applies to the expiration of the underlying, not to the option expiration. So that's important. Timed option expiration is going to be used to compute D1 and D2. Now, how about a swaption? This is even cooler, right? So you have a swap contract, which typically the plain old vanilla interest rate swap, you swap fixed for floating or floating for fixed, depending if you're the payer or the receiver. And so it makes sense that somebody out there would have said something like, if I can enter a swap contract, why can't I enter an option on that swap contract? So what is a swaption? It gives the owner the right, but not the obligation to enter an interest rate swap. So payer swaption, so we're going to pay the fixed and receive floating. Receiver swaption will do just the opposite, receive fixed and pay floating. So for the payer swaption, we're betting that the interest rate goes up, right? And with a receiver, we're betting on just the opposite. And so the values of the payer and receiver swaptions are just like what they were from before, but with a slight adjustment. We're going to take that R fixed minus the RK. So all we're doing is saying, there's that. Remember when we did that we computed the fixed rate on a plain vanilla regular old interest rate swap. And then we're going to take the present value, and we're going to do the PVA here is the present value of the annuity. Remember that swap contracts were originated so that bondholders could hedge their interest rate risk in terms of volatility in coupon payments versus their fixed coupon payment. And so bonds pay interest every 6 months. So swap contracts then are revalued at the end of every 6 months. So it makes sense to avoid continuous compounding. So just present value of the annuity there. And there, look at that very bottom arrow point. So there's the present value of the annuity, the PVA. So that's just present value like we've done before. And so all of those variables are virtually identical to what we've done in the past, but with, of course, some adjustments. All right, moving on to the Greeks. And so the Greeks, these all started with delta. So delta, that's a derivative. And so all these are kinds of derivatives. So knowledge of calculus is super helpful. But my take on the interpret each of the option Greeks would be, for me to have an LOS as a good educator, I would say calculate all of the option Greeks and then interpret it. But you guys don't have to do that. So we have the delta, gamma, vega, rho, and theta. And so this is probably a super good time for you to get out your phones and take a picture of this slide. And so the easiest thing to remember is that, for call options, notice there's a bunch of greens in there. So that means that there is a positive relationship. Strike price really is just the only one that's negative related. And that makes sense, right, for the call. If my exercise price in my first example wasn't 90, but it was 200, then the value of that call goes way down to nearly zero. That makes perfect sense. But and then the opposite holds true for puts. So let me just spend a moment going through the middle column under the call option. And let's go ahead and start with the delta, right? The delta of the call option measures the sensitivity of the call price to changes in the stock price. And so what we're doing here is that we're trying to figure out how much do we care if the stock price goes up or down? Well, of course we care, but the question then becomes, how much do we care? I mean, if the delta is 0, then we don't care at all. If the delta is 1, then we care a lot. And here's one of the really, really super cool things here. And I've waited to say this. The ND1 of the Black-Scholes-Merton option pricing model is the delta of a call option. And so I want you to think about delta in the following way. Think of an example where stock price is 50 and the exercise price or strike price is also 50. We call that an at-the-money option. So if we believe in this Brownian motion process, that stock prices, they could go up or they could go down, the delta of an at-the-money option is going to be somewhere around 0.5, because if the stock price goes up by $1, then the call price will go up by about 50 cents. So that's an at-the-money option, positively related. Gamma then is another derivative on top of that first derivative. So that measures the sensitivity of delta to changes in the call price. So we're trying to figure out exactly what that changes in delta means for call prices, and that's positively related. Vega, we know this from my earlier example about the water company and Amazon. So lots and lots of volatility is great for call prices. Let's skip the risk-free rate for just a second. Theta, time to expiration. I mean, what happens? We call this decay, right? As a 6-month option sooner or later becomes a 5-month option, and then a 4-month, and a 2-month, and a 1-month, and a 1 week, and then a 1-day option. And so, of course, a 6-month option has way more value than a 6-day option. Now, those are relatively obvious notions here, but the risk-free rate is not quite as obvious. So let me give you a quick example here to explain this. Suppose that we have a share of stock that's trading for $10, and there is a call option written on that share of stock, and the strike price is $10, an at-the-money option. So you might pay me, depending on volatility and other variables, you might pay me $1 or $2 for that option, right? Maybe even 50 cents or 10 cents, right? So let's just pick $1. So if you bought the share of stock, you'd have to pay 10 bucks. But if you bought the option, all you'd have to do is pay $1, which means you have $9. You have $9 that you were supposed to be required to pay for the share of stock that you can do something else with. So let's suppose you take that $9 and you invest it in a risk-free security. Well, the future value of that $9 will increase as the risk-free rate increases. Therefore, you're willing to pay more for that call option. So the row tells us that as the risk-free rate goes up, so does the call price. Let's go ahead and talk a little bit more about Delta. And that illustration over there on the right ought to be the extra step that I'm going to make here based on my discussion previously of that 0.5 Delta. All right, so let's look up at the top right, a deep in-the-money call option, right? So if we have a stock that's trading at 100 and the exercise price is 100, that delta is going to be about 0.5, right? We said that earlier. But let's suppose the stock price goes up to 200 and 300 and 400. We call that deep in the money, right? You have the right to buy at 100 and the stock is trading at $3 or $4 or $500. Well, the delta is going to be near $1. For every dollar that the stock price goes up, the call price will go up by that. And this is a scenario under which the stock price and the call option, they behave identically. Now, of course, just the opposite example, suppose the stock price falls down to, $5 or $3 or $1, and the stock price goes up by $1, the option price is going to yawn, right? Nobody cares. The option price is not going to change by anything because the probability that the option is going to be exercised is, probably close to zero. And then you can do the same thing with put options. Delta of 0 and a delta of a -1. And then notice that we remind you there at the bottom, delta continuously compounded dividend yield. So don't forget to consider dividends. So make sure when you read the question stem, if the CFA Institute gives you dividends, make sure you're aware. There's that gamma. Somehow you're going to have to put that in there. One quick note, look under option deltas of calls. There we go. Delta of the calls equal to ND1. I was telling you that earlier. So there it is in bold. All right, gamma, the rate of change of the portfolio delta with a change in the underlying price. So this shows curvature, right? I told you it was a second derivative. Gamma is always positive, and it's at its highest value when the option is at the money and close to expiration. So this goes back to my suggestion that at the money options have deltas of somewhere around 0.5, and then that gamma is always going to be at its highest rate. Deep in the money or deep out of the money, they have low gammas. So look at that. What is that? The purple diamond point. This is probably a good question on the exam. Portfolio gamma can be lowered by going short options and increased by going long options. So that's super important there. And for those of you who like some calculus and like some equations, there's the formula for gamma. Maybe you should note that the gamma is identical for both calls and puts. Theta, passage over time. There's that fourth diamond point known as time decay. Theta of a stock is 0, so they don't have any expiration dates. Usually negative as the expiration date gets clear. All right, we said that earlier. Vega, sensitivity of the portfolio given small change in the assumed level of volatility. And by the way, this is the most difficult input. It's the fifth input, right, in our model, but it's also the most difficult to either observe or estimate. In fact, there are tons of people out there who are making tons and tons of money because they have proprietary standard deviation models that can be used as more accurate predictors of what the actual volatility is than what the competition. Yes, of course, Vega of both call and put options are equal and always positive. That makes sense. And then there's the couple of things for the rate of interest. Positive for call options, so the opposite for put options. That makes sense. All right, let's move to this concept of delta hedging. And recall back in the part 1 binomial option pricing model slide deck, we showed you how to hedge using the hedge ratio in the binomial model. Well, the same thing can be applied here in the Black-Scholes-Merton option pricing model. But what we're going to do is we're going to use the really cool stuff from Black-Scholes-Merton, like that ND1, and we're going to form a portfolio, and it's going to be what's known as delta-hedged. And let me give you just a quick example here. Let's suppose we have a stock price of 100, exercise price of 100. That's an at-the-money option, which means that the delta is going to be around 0.5. And let's suppose that the price of that call option is $10, just so that we can do the easy rounding. So how about if we form a portfolio like this? Let's buy 1 share of stock, and let's write 2 options. So we buy that 1 share of stock, we're out $100. If we write 2 options, we get $20, right? 2 times 10, that gives us $20. So our net portfolio value, our position is $80, right? 100 minus 20. Now, if the stock price goes up by $1, let's just say it goes up by $1, it goes from 100 to 101. So that's good news for our position in owning the share of stock. What will happen to our call price? It'll go from 10 up to 10.50. And we have 2 of those, so you multiply that by 2, that gets you 21. What's the position of our portfolio? Well, it's 101 minus the 21, that gets us back to 80. So this is the nature of a delta neutral hedge. Look at that third circle point. A delta neutral portfolio does not change in value for small changes in the underlying price, because whatever happens in the underlying stock price is then offset by changes in the underlying, and changes in the call price, but you have to have more. You have to have more of the call options. So look at the next one, rebalancing. Delta neutral portfolios must be rebalanced continuously to maintain a constant portfolio delta of 0. This is called dynamic hedging. And notice, I'm going to repeat this, balanced continuously. You could also do some static delta hedging, which involves constructing the initial portfolio and then never adjusting it. And so when stock prices go way, way up or way, way down during the life of the option, that static delta hedging is just not very effective. So how do we do this? That was my example with the 100 and the 20, right? Long stocks and then write the call option. But you can also do this with stocks and put options and call options and put options. Let's take just a quick example here. Let's suppose that we have 1,500 shares of stock. Call options with a delta of 0.5 are used to hedge. So what do? We have to have a position of 3,000 call options, right? This means that we must sell 3,000 call options to achieve delta neutrality, which is exactly what I was doing just a moment ago with my example in the $80. Now, here's a really important slide here. I'm going to read that first arrow point to you. Gamma is the measure of the risk that remains once the portfolio is delta neutral, and this is a nonlinear risk. Now, remember that the reason that this arises is because although the Black-Scholes-Merton pricing model assumes that the share prices change continuously over time, this is probably not reflective of reality. And so essentially what happens is, think of 2020 and 2021 GameStop stock price. What happens? It was way down here, and then the short positions, and then it went way up here, and then it went way down, and then way up, and way up. My students want to talk about GameStop stock price all the time, and they want my opinion on it, and I usually say something like, you know what, your time is better spent somewhere else, because I have no idea why that stock price would go way up or way down. I mean, I have some good ideas, but I don't have some definite answers. And that pretty much takes us through our LOSs. And so I would love to be able to give my opinion and say, I think these are super important, but I think all of these are equally important. If I'd have to pick one, I'd have to go back up to the second one, interpret the components. And so knowing all of the stuff that goes into Black-Scholes-Merton, it pretty much helps you answer all of those other LOSs.